for the next section. Bear with me one quick second. Sorry. All right, quick reminder. We will have the encore presentation of the entirety of day one at 6 p.m. New York time. This evening, same login credentials, same Zoom credentials as tonight, as you did use for today's session, and also again for days 2, 3, 4, and 5, even though you may be getting emails from Zoom that might show a different schedule or time or calendar. Don't worry about that. Just ignore that. Just realize it is the same credentials for each day starting at 9:30 a.m. New York time for the event tomorrow. We will have two more sessions here today. Then we'll have the Q&A session. I'll explain to you how the questions and answers process will work after this next session, but we will be continuing here. Mark, you left off at 67. I'm sorry, 6, but 67, 66, and 7, sorry, were right before fundamentals. So I don't know if you wanted to specifically address those or not, but otherwise, um,
67 and 6. We did.
oh,
I went,
okay.
yeah,
Then you
we're
went back.
good.
Okay.
Now we're on 68 now.
Yeah, 68 fundamentals, and we'll have a break after this. This should last about an hour and 15 minutes or so, and we'll take one more break then before the last session of the day, and then Q&A. Take it away, Mark.
Okay, welcome back. 2025 Master Trader Program online, 16th year. Let's recap. We went over categories, right? You got the market leader, top competitor, institutional favorite, turnaround situation. We talked about commodity plays and cyclicals and how we want to tend to minimize or avoid, or certainly the cyclicals don't get the attention like the key market leaders and the growth stocks do. Valuation. What was the net of the valuation conversation? Well, we're not really too concerned with valuation, to be honest with you. As a matter of fact, if I had the um, if I had the choice of buying a stock that was, let's say, moving into new high ground, had great earnings, had all the characteristics in an uptrend, and it was trading at two times the S&P. Let's say the S&P is trading at 18 and it's 36 PE, or one third the S&P and it's trading at a 7 PE. I'd take the high PE all day long because that tells me something's going on. That's something's happening strong and good. There's a high expectation, and maybe it doesn't continue, but at least we know something's going on and something, and we're paying up for the price, but that gives us a better probability that we're in a strong leader as opposed to, matter of fact, that if the PE is really low, that could indicate that there's something really wrong and this company might be headed for bankruptcy or some real big problem. Um, if you're a value buyer, then you're going to be looking at this in a very different way. And both of us can make money. A lot of times I'm buying stocks that someone like a Bill Miller has sold. I might be buying stock that he's selling. Um, you know, but we can both make money. It's in that cycle, that maturation cycle. There's a lot of price action in there, but I'm concentrating on one part of that maturation cycle, and I'm an expert in that. I don't know anything about any other strategies. People ask me, "Oh, what do you think of this strategy?" I don't know anything about anybody else's strategy, but I know everything about my strategy. And if there's any golden nugget, that's the golden nugget. You need to know everything about your strategy, become a master at one thing. Because once you master one strategy, you won't need any other strategies. That's the key. Okay? You won't need any other strategies. You only need one strategy.
Yeah, the
So
specialist is the one who gets paid.
yeah, and then we talked about the trend, right? The trend is more of a qualifier where we are buying stocks because we are buying continuations of existing trends. We're not looking to forecast, right? We're not forecasting. We're responding and we're buying an existing trend to increase the probabilities, to increase the likelihood that we're in a big winning stock, and to make sure that we've already see that the institutions do have an appetite for the stock, which we're going to show you why later in much, much more detail, getting into the supply demand and really getting forensic on it. Um, and mainly because we want to know what to expect, what to expect under certain conditions, and we've got to build those conditions and build those guardrails so we know how much latitude we have between those guardrails. All right, so now we're going to get into fundamentals. Now, if you're a short-term trader, fundamentals aren't nearly as important as if you're holding for a longer term move and you're going to hold through several earnings reports. If you're trading short-term wiggles, especially if you're a day trader, then it really is immaterial unless maybe you're trading earnings gaps and things like that. But I like to use all that's available to me. Why just uh, focus on one thing when you have other um, characteristics, other things that are going to help identify those big winning stocks, those fast moving stocks, and are also going to let you know where you are within. Again, if you're a turnaround situation, you know what to expect, not only maybe from the stock price, like we talked about with trends, but looking at the earnings, knowing what we need to see for that to be an effective or a valid turnaround that it's actually turning around, meaning that we've now got really big earnings in the most recent quarters because the comps are so easy, right? So let's talk about that. Let's get into the earnings. The first thing is to put this into perspective is there's three ways a company can grow their earnings. All right, one is by selling more, the other is by raising prices, and the other is by cutting cost. You can raise price, sell more of an existing product. You can sell a new product, more volume. Um, you can raise prices. You can cut costs. You can improve productivity. You can rid losing operations. The real key to understand is that when you cut cost, but if you increase your growth in your earnings by margin improvement, it has a limited lifespan because there's only so many costs you can cut, and you get down to the bare minimum of how to run a business. And there's only so much productivity enhancements and so many operations that you can rid before you're down to bare bones, and then you got to grow the company. You've got to grow the revenue. So it really comes down to revenue. All right, that's where you're going to get a big move. You're going to need to get the revenue is going to need to grow. So we talked about the four stages, the maturation cycle, as far as the price action, the trend, right? Stage two going up, stage three, stage four, the basing stage, consolidation being one. With within that, there's a there's another maturation cycle of the earnings cycle that takes place, and it doesn't necessarily correlate perfectly, but it is also fairly predictable, and you can see how it operates with the price. The price does discount to a certain degree, but the way it works is, especially today, there's more than ever, computers are really involved in valuing stocks and screening for stocks and picking stocks and so forth. Computers help us with everything, and now AI. This is just becoming more and more of a process driven, automated process driven, where you start off, maybe you've got a stock, it's a value. At some point, there's some surprise, some positive development. Stocks love when there's an unexpected positive event, and they hate when there's an unexpected negative event, right? They want to have expectations known. Just like I said, I want to know what to expect. Well, that's what the street wants. And when you get something that you don't expect, well, that makes you nervous, right? I'm going to sell the stock. If it starts doing things that I didn't expect, I'm going to sell the stock. And big institutions are no different. So you get these positive models will kick in, and then they revise their estimates. It's all driven by estimate revision, by trying to figure out what this company is going to earn 1 or 2 quarters down the road. And most of the really big investment mutual funds and hedge funds, they have a pretty good idea of what a company is going to earn 1 or 2 quarters. They can nail it down. They're talking to the vendors, they're talking to looking at the whole, doing channel checks, talking to the suppliers, everybody, and really they have everything nailed down. They've got a team of analysts following, something like Amazon at Fidelity is followed by a bunch of analysts, MBAs, CFAs, all crunching every number, and they know the whole pipeline. Well, at some point, you get where these companies become the quote unquote growth stock. They're thought of as this is a stock we can pretty much count on. It grows its earnings. It's predictable. That's when you have to be careful. That's when you get into where it starts turning into an institutional favorite, and that's where you'll start to see a loss of earnings momentum. And sometimes you can have the earnings start to trail off for years, and they don't go negative, but maybe they were growing at 80%. I remember when Dell was growing at about 80% per annum, and then the growth slowed to about 30, which was very strong growth. I mean, 30% is strong growth to grow a company, but the expectation and the stock was moving on 80% growth, and when that growth slowed down, the stock topped, and that was pretty much it. And sometimes also that growth will slow down before it slows down even more significantly. So what will happen is you'll get some negative surprises. The company will come out and it will say, "Hey, we're going to miss estimates this quarter. Things didn't work out as expected," and now the negative surprise models come in. The earnings are revised down, and eventually the stock, of course, becomes back to being a value stock, or just being down and out, and being in stage one. That's the way it works. Okay, this is the way it works, and generally stocks will go up on earnings surprises, down, and you'll see again, like we talked about serial gappers, you'll get serial surprises. Same thing like the gaps, and a lot of times the earnings will be the gaps. The stock will gap on earnings. Then what you get is what's called post earnings drift. If you have growth, this particularly when you have a very high growth situation. This is what we're relying upon for inefficient pricing is post earnings drift, which means that okay, this stock gapped up on earnings here in September, right? This is Lululemon. I was actually buying it coming right over here, right around this 22-ish level. The earnings are really great. If the company is growing fast enough, the stock is not able to accurately figure out what's going to happen in the future. And that's why stocks can get dramatically overvalued and stay overvalued for a long period of time, because these estimates, it's kind of automatic. They just keep revising the estimates as they're beating the numbers, and they're issuing surprises. They keep raising them until finally they go too far, and then they disappoint on the downside. Here's the key. Here's the real key. Okay, estimates are revised very slow and very conservatively, because analysts want to keep their jobs. Okay. No one wants to go too far outside. Like for instance, this isn't any particular stock, but you'll see the number of estimates. There's 14 estimates here, 30 days out. So there's 14 analysts. If you look at all the analysts, they tend to bunch around each other, and no one really wants to be a rogue and go too far out from it. Just like if you lose your money in IBM, you're safe because you put it in IBM. Same thing. If you make an estimate that's not too far from the herd, you can say, hey, that's what everybody, we're all expecting that. So no one wants to go too far outside that. That's great news. That's great news, because once again, it means that when a company is growing really strongly, and they're going to have this acceleration and growth, it's not going to be discounted, because there's not efficiency there. So it's slowly and conservatively with limited visibility, and limited visibility is what creates your gigantic opportunity. And the larger the earnings, the faster the growth, the the more the less visibility there is.
Yeah, golden nugget. And that's what creates the inefficient pricing Mark is talking about.
This is as golden nugget as it gets. But now this isn't really tactical, okay? Except the fact that you should be concentrating on stocks that are growing fast or have, even if they're not growing fast, let's say a biotech, like biotechs, we talked about earnings and said, O'Neill would never buy a stock without earnings. Well, O'Neill missed a lot of biotechs too that didn't have earnings, and I bought lots of biotechs that didn't have earnings because 75%, this is going back to the nature of the category, 75-80% of biotechs don't have earnings. So you're not trading on that catalyst. But there is the potential for a blockbuster drug sometimes that that that's the future that's trading on, and that can't be fully discounted either. Usually it's not, especially if it's a smaller company that's not widely followed. This is why we want to have high growth, and we want to have somewhat underfollowed names that aren't too popular yet, that have been around and become institutional favorites where everybody owns them. Because if everybody owns it, well, now all there is supply. There's just selling potential, because if you've already bought it, how do you buy it, right? So this is the making of a big winner. This is what makes a big winner. And it's important that you understand this, because this is what guides you to where you focus your energy, and where you focus your efforts, and where you're looking, and you don't get caught into this trap of buying I don't know, Dare, or Apple when it's down because it's Apple. Again, it might work. It might work for a while, but eventually you're going to be buying a laggard, and you want to buy leaders. You want to buy the leaders. You want to buy the best names. You want to buy the names that have big growth ahead, are inefficiently priced, and you can make a lot of money. And even if you're not holding for the long term, you want rapid movement because you want to maximize compounding. Remember, we're going to go right back. Everything builds on what we previously talked about. Maximize compounding. To do that, we can do it in a number of ways. But one of the main ways is to, as Mark said, have efficient use of the capital, and then you can roll that capital over. The faster you make money on that capital, the faster you can compound it, rotate it, get it out of this situation, move it. If my stock goes up 20% in a month, well, that gives me 11 more months to put that money somewhere else, as opposed to you buy a stock, it takes the whole year to go up 20%, right? Who's better off? I'm using way better use of my capital, and I'm able to compound that. Now, we talked about Cisco, right? Matter of fact, right here, this big up month, I believe there's a monthly chart here. This big move up, getting into new high ground. I bought Cisco right there. This was in 1990, going right to 91. I bought Cisco right off of the IPO base, and I sold it 5 points higher. And then it went up like 70,000%. But I made more than that trading. But the bottom line is, this was a stock that the law of large numbers made it a huge winner. And here's what I want you to do. If we take, in this case, I'm going to take we'll call it $1 million. This is $100. Let's just say $1 million, $700,000. Let's say you have a plumbing business. You're an electric contractor, right? You gross, I don't know, $750,000 last year, and you made $200,000 or $300,000. You got a pretty nice little business. Okay, Cisco doubled. They more than doubled their earnings every quarter for, I believe it was 12 or 16 quarters. But let's just use 8 quarters. Let's just say you, as this small business that does 700,000, my brother has a pizza restaurant. He does $1 million, $1.3 million a year. That's $200,000, $300,000, $400,000. Okay, let's grow that at 100%. 1 quarter, and then the next 3 months we grow it at 100% for 2 years, 8 quarters. You know what you have? You've got I don't know, Fortune 500 company, but you certainly have a mega monstrous multi-$100 million organization, if not a $1 billion organization. Just do the math. So $100 turns into $25,600 in 8 quarters, in 2 years. All right, take that and make that 1,000, make that a million. $1 million company goes to 256 times that. What's that? 2.5 billion, or is it 225 billion? You're a pretty big company in a very short period of time. Now, do you think that a company that goes from 100 million to, let's just call it 2.5 billion, is going to be worth more? You bet it. You bet it's gonna. And do you think that anybody can know for sure that in 8 quarters from now that a company's gonna deliver like that? Nobody. Nobody. The CEO himself couldn't see past a couple quarters. And that is where the opportunity is. And that's why the efficient market hypothesis is not true. It's true in some cases, and the market in as a whole is very, very random. It's very random. Is it completely random and completely efficient? Absolutely not. And when you drill down to individual stocks and then you start putting these elements together where you qualify them and you're using a subgroup, then there's massive inefficiencies. So you have to pull away from the crowd. You've got to be willing to go in and find the inefficiencies in the market. And these are the ways you do it. This is the way these are the ways institutions do it. The institutions though have their hands tied because they can only invest so much in one of these companies. They can't make these large investments like you can, and they can't move very quickly when when they don't pan out and move into another one and move the capital around so rapidly. They don't have the flexibility that you have as an individual investor. So you have this gigantic advantage. People think that the institutions and the professionals have the advantage. Complete opposite. The smaller you are as an investor, the bigger advantage you have. That's why I I made my huge returns when I was small. I mean, I have a liquidity problem now. It's not a liquidity problem like an institution, but I do have a liquidity problem. Mark Ritchie has a liquidity problem now. He's managed $25 million. When he was started off with 50,000, he put the whole portfolio in one stock in and out. Well, now we can't do that. We can't do that. So
This is a massive golden nugget, especially for people that are new, because nearly everything you hear out there is the opposite. You know, the institutions have all the advantage and they've got the superiority. The reality is that arming yourself with what you're learning here gives you an enormous edge over other players.
now you got to think of it as the big institutions are like cruise ships, and you've got a speedboat. Okay, in order to turn that cruise ship around and think of it as, to get it in one direction, they got to build into a position, to a stock, get that get that position going in that direction, get that cruise ship going, and now they got to turn it around. They want to turn around and go back to port. Not working out. The weather just turned bad, and we need to turn around. Well, the speedboat is going to go zip, turn around in a couple seconds and be way back, going back into port much quicker. You're captaining a cruise ship. That's going to take a long, long time to get that thing turned around. So you have a big advantage. Now, I want to talk about some very key rules here, because when we get into numbers, when we get into fundamentals, what happens is people love to hybrid things, and they say, okay, I'm going to buy this company. It's got, these great fundamentals, great product, but the stock is down. I know Minervini said to not buy the stocks when they're down and below the 200, but this thing has got great numbers. Everything is great happening. Okay, that we want to have the fundamentals, but we never rely upon them over price, right? So the key rule is you never trust the story, you never trust the numbers unless confirmed by price action. So all this is important, but it all goes out the window if the price action isn't acting right. Why is that? Well, because number one, stocks are a discounting mechanism. So even though it may look good on the surface, if the institutions are selling, they're looking forward, and it doesn't really matter, because when the institutions are selling and you've got that downtrend, again, we want the tide. We want the tide going in our direction. You can't fight the big institutional wave. You've got to have that wind in your sails. So the likelihood that you've got a winner is much less, because again, we go right back to the probabilities and the studies, right? If it's below the 200-day moving average, zero stocks made big moves below the 200. So why not wait? Just because it's got great numbers. Don't trust your don't trust your ears, trust your eyes. Don't trust the numbers, trust the chart. Only trust the numbers, only trust the story, only trust the great product and all the fanfare around it. Why is it not going up? If the stock is so wonderful, the management's so good, the products are so good, everything's going so great, why is the stock below the 200-day? Why is the stock going down? Why is the RS below 68? Because something's wrong. Let me show you something I call differential disclosure. Differential disclosure is a term used by forensic accountants where they'll look at documents and they'll look at, say, the company's annual report, what they're reporting to shareholders, and then they'll look at the SEC documents and look for discrepancies where there's differences. Or one key rule is you got a company that's making a lot of money, but they're not paying much in taxes. And you go look at the tax returns and they're not paying anything in taxes, but they claim to be making a lot of money. These are red flags. These are things that forensic accountants look for when they analyze balance sheet, and they mainly go to the footnotes and look at all these little caveats and footnotes and double starred areas and try to find where the company may be, spinning things. Um, well, here I took differential disclosure to a different arena, if you will. I use it in a way very similar. I'm looking for the discrepancy. The discrepancies for me, are between the price action and the fundamentals. Meaning, okay, the company comes out with this huge earnings report. They beat estimates by 4 cents. It's up 150%, but the stock's down 20% on the largest volume ever in the history of the price action. Am I going to go buy that stock because they came out with this great earnings report? Or am I going to say, you know what? That earnings report obviously wasn't that good because that's not my Aunt Betty selling. All right. Those are institutions piling out. This happened with Crocs. I owned Crocs. I was in Crocs through a big part of the move. And I think even David Ryan said that he was in it until this blow up and got out on that day. They came out with earnings that were up 144%, and the stock sold off huge on that. It was the largest price decline on the largest volume. And when you get the largest 1-day price decline, especially if it's also on the largest weekly with the largest volume, that is an absolute run for the hills because that's telling you that institutions are piling out at the largest, fastest rate that they've ever done this. And what happens is th- stocks tend to take the stairs up and the elevator down. That's the saying. This happens very often on the downside where you'll get the money will run out of the stock before the bad news comes. Here, this was what happened with Crocs. They had these really great earnings, triple digit earnings, right? On that last triple digit earning right here, that's where the stock broke. Then the next quarter, there was some deceleration, about a 50% deceleration. Look at the negative earnings, year over year earnings, the stock's already down before that news comes out. You see, the stock is discounting it. It's
Yeah, and Mark,
discounting.
I just wanted to highlight too, because this is again, we're building and putting these things together. And one of the things he highlighted at the beginning of the section in slide 70 is sometimes it's just the loss of the momentum because most people would think 144%. Well, why is it down so much? And they'd be tempted to buy or whatever. Well, you can see we went from 333 down to 144. So the market is telling you this stock is losing that momentum, or in some cases that in the case of Crocs, that was a fad. Well, maybe they've already priced in the fact that every man, woman, and child in America owns a pair of these things, and that
Right.
growth is going away. And I think there was an earlier, it was page 36. That's when our slide 36 is then when you get, and that entire period, I remember there were value players then saying, well, Crocs is a value buy now. And it just went down, down, down the whole way. Right there. Exactly.
Oh yeah, that was right before the big decline. It was at the lowest PE, and that's where all of a sudden it became a value stock. Right, but that's right before there was something severely wrong happening. Let me go refine my place now here.
Yeah, page 79.
Yeah, I got it. So let's look at another one. Vicor. This is a stock that I was in 1991. It was an IPO base. It came out right here. I was in this name. You can see earnings really strong, triple digit. Then they had a little bit of deceleration, started coming off, and it went right in to where it was already down. And then you see, look at the negative earnings, look at the flat earnings. The earnings look at the difference in the earnings picture here of these 4 quarters to these 4 quarters. But you see the stock coming down very fast because it's expecting that. It's discounting that. This is what I call differential disclosure. So when you get an earnings report, here's a stock that broke. Okay, it broke on an earnings report that was EPS 46%, 38 versus 37. It beat estimates slightly, so that was an earnings surprise, albeit a small earnings surprise. Also surprised on revenue. Sales were up 36% on 288 million versus 282 million. Stock breaks. Now, big decline in the stock. Stock goes down from that first break, I don't know, 75-ish, comes all the way down to 40-ish. Then the next earnings report comes out, and now big gap down. Now we get the bad news, right? Now there you go, down 27%, sales negative. See, this was a major break. There's a major break in the stock, and every time you have a major break, you got to trust your eyes. You got to trust your eyes. Also, guidance. You can have a stock that it beats estimates, but they guide lower. Now, you don't have to figure all this out. Okay. You don't, the stock is going to be your best indicator. The stock's going to be your indicator. You can see that most of the time, these stocks are rolling over prior to even getting the news. By the time the news starts becoming apparent, just like right here, I don't know how I got all these little things in here. Let's see. Can I erase those? This an erase? Let's see. Yep. There we go. I don't know how that happened. Um, let me get out of this annotation. Um, you start topping here, right? Beats estimates by 14 cents. Company guides higher. EPS 133%. Well, stock tops right after that. Earnings come out 96%. Earnings still look good, but the stock gets slammed. Now you get a rally back here. This is looking like a snapback of dead cat bounce that you should be shorting. EPS 233%, right? But this is getting into a short position now, and earnings are still looking pretty good. Now, significant deceleration, slowing, really starting to show up. And now, after the stock has been completely imploded, right, and maybe even bottomed, now the EPS comes in 6% and all the growth is gone. See, the stock discounted all that. So you've got to get used to a couple things. One, that stocks are discounting mechanisms. And while particularly on the downside is where you got to be really careful and get out while the getting's good. On the upside, stocks can have moves. They can have secular moves that go on for years. So you want the earnings to be on the table. They could keep producing good earnings, but when that punch bowl is taken away, it usually happens pretty quickly. Um, that's one thing. The second thing is a good company doesn't necessarily make a good stock. Right? I remember when somebody made this example a long time ago. I don't remember if it was on CNBC. I heard it somewhere, but I thought it was a great point to point out. This is when Tilray, it was the marijuana stock, went up 1,000% in 5 weeks. They had 28 million in revenue, 330 employees, and at the time they were founded in 2013, and I think this was at 2000. Forget what this year was, but it wasn't
2013, yeah.
Yeah, 2013.
This was the IPO, or yeah, it might have been 2016 or 17.
That's right. You're right. Yeah, this was the IPO base actually. Macy's, which was founded in 1858, has 130,000 employees and 25 billion in revenue. Look at this, did nothing. While this stock went up 1,000%. Which is the better company? Which is the safe company? Which one would you bet on still being around, right? So again, a good company doesn't make a good stock, and sometimes even a bad company can make a good stock when the earnings are coming through and they're discounting the future. Now,
Tilray, ironically, I think went on to lose 99% of its value as well to the 50/80 rule. So that's
Right.
if you fell in love with the Tilray story, you wound up, underwater eventually.
Right. We don't fall in love with any stock. There's another saying, your stocks are meant to be to date, not get married to. And if you're going to get married to it, now people say, oh, he doesn't like to hold stocks. No, I don't mind holding stocks. I don't like holding losses. So as long as your stock is in the profitable column, if it's up and you're not at a loss, fine. If you want to set your stop and set it and forget it, Maybe you'll have the next Amazon. You can hold it for the next 20 years. But we're going to make sure it's in an uptrend. It's above the 200-day moving average, and we're not going to hold losses. That's the main rule. We'll get to that stuff later, though. Quarterly earnings. All right. Another thing, when you look back, and I'm not going to go back to the study right now, but you can look at the O'Neill study. You look at the facts. The facts are that the quarterly earnings are up significantly in the most recent quarters, and even the estimates going forward are generally up when you get into the big leaders. So when you look at big winning stocks, 90 some odd percent, 95% of them had some form of acceleration, some form of earnings acceleration in the previous quarters, in the previous 6 to 8 quarters. You can look for it in the most recent quarters. Sometimes it'll show up. You see 4%, 10%, 208. Sales 15, 21, 97. Again, this is very CanSlimish here, we're talking about. But CanSlim, it doesn't matter the name you want to put on it. This is no different than any growth manager in the country or the world is going to be looking for, because this has nothing to do with the label on it. This has to do with the way it works. Companies making more money, it's accelerating. Well, that means that now the estimates have to be revised up. Remember, they're going to be revised slowly and conservatively. There's limited visibility when you have big numbers. So that means you can get earnings, you can get post earnings drift. That's the whole thing that we just went over, all in chronological order. So,
Mark, have you gotten to the breakout year yet? I don't think you've gotten there
nope,
yet.
no.
Okay, I just wanted to point that out. Okay.
Yeah, we're coming right now. Sales too. If you got sales accelerating, that's very strong too. I bought Kenneth Cole Productions. This was back in '95, when I was first starting to really know what I was doing and applying this stuff in the right way. You could see very strong earnings. You don't necessarily have to have, when you look for acceleration, if it's not completely perfectly sequential, triple digits are good enough. If it's up 100 and 250 and then up 100, you don't look at that as, oh, 50% deceleration. Yes, it is, but they're so big that it doesn't matter at that point. And even if you have really good earnings like 41, 117, 48, 283, Facebook, you could see when they first went public, you had a big decline. The stock took some time to consolidate until the earnings started coming in. If you took a 2-quarter average, you can see it's just accelerating. And that's, sometimes I'll smooth them out and I'll look at it at a 2-quarter average. So just, look for acceleration. That's a really good, that's a good characteristic and a characteristic of big winners. If you have triple digits, it doesn't need to accelerate. As long as if they're triple digits or even 90, 100%, that's big enough growth. You'll see during these big moves, look at what the growth averages. Big growth. Annual earnings too. Your quarterlies are going to translate into annuals. So you'll get acceleration in the annuals too. You're looking for acceleration. You're looking for somewhere to find some acceleration. Home Depot, I'll tell you a little story about Home Depot. I went, I was asked to go to George Soros's office to talk to them, to talk to Stanley Druckenmiller's crew about them buying research from me or having me consult them. And when I got there, Druckenmiller asked me if I liked Home Depot. He said that they were buying it heavily, and it was right around here. And I had seen the stock, move up and the growth start to evaporate. And the stock started coming off. And I said, you're buying that now? I mean, that looks like that stock is topping and, that the best growth is behind it. And he said, write that man a check. I couldn't influence his decision. He said, actually, we're shorting it. I just wanted to see if you would placate me and you would agree with me. And I went completely against, his opinion, and just told him, I said, the earnings look like they're decelerating and the stock looks like it's topped. It's stage 3. It's made a big move. And now look forward here. This isn't about forecasting. It's just about taking things at face value. You have an average between 92 and 98, 24% growth. And you see the stock when it makes its big move, see growth almost doubles. It averages 39%. big acceleration in the growth. That's why the stock's going sideways here, and then it has the nice move. And then when the stock tops, see the growth, it averages through this period 15%, about half. So it doubles and then it cuts in half. And if you just go and you look at the average EPS during the two periods, the big up period and the big down period, it's almost cut in half. You average 20%, 27% per annum here. You average 15% per annum here. So even though 15% may be pretty good, it's a big deceleration. But you would have picked that up because the stock went into stage 3 and then went into stage 4, and you should be out of it. This is stage 2. This is the only place that you should be in the stock. Another way to spot this condition, particularly on the upside, is to look for what we call a breakout year. This is something that institutions, they use various models and regression and standard deviation, but a very simple way to do it, and the way I've been doing it for, I don't know, 30 years, and I haven't found it I haven't found the need to do it in any more complex way than to just look for a breakout year, either in the actuals or the estimates. So when you get a stock that's been in a range on the annuals, now, key point, stock's in an uptrend, right? It's above the 200-day. This doesn't matter. If it doesn't meet the conditions and it doesn't meet the qualifiers, then I don't care what any of these fundamentals say, I'm not buying the stock. It's met the conditions. It's in the uptrend. It's above the 200-day. 200 days in an uptrend. It meets all those conditions. Okay, now I want to find those stocks that have some acceleration. Well, one of the places I can look is to see if there's a breakout year where you might have earnings that are in a range bound trend for 3-4 years or so, sometimes even longer, and then it breaks out of that range and the stock is acting well. That's another place to look for acceleration. Turnaround situations. When you're in a turnaround situation, you look at the growth rate. You look at the sequential, year-over-year sequential acceleration. You want to see big earnings in the most recent quarter or two. And if you don't have it in the most recent 2 quarters, you want to see it in the current quarter and the next quarter's estimate. Triple digits, the bigger the better, because you're going against very easy comps. You're going against negative earnings or really small numbers that are easy to beat. And so you have to demand. So you look at the growth rate and what are the current earnings to the growth rate, and is the growth rate accelerating? So maybe the growth rate over the last 3 years, stock's been growing at 12%, and suddenly it's growing at 44, 183, and next quarter it's gonna be up 900%. That's a situation that might be a valid turnaround situation.
Mark just brushed over another, I think, golden nugget that's really important on this fundamental side, and it's where it sits in context. We're assuming, and it's really important, that this is already in a stage 2. And one of the ways he often talks about this is, listen, we're not going to trade the fundamentals without the technical confirmation. And I hear all the time somebody, giving me this great case or whatever, and then I look at the chart and it's in a stage 3 or a 4. And I go, well, I'll look at it again when it's back in stage 2.
Yeah. Now, some people, some traders are pure technicians. They don't look at any, they just trust the chart. And you can do it that way too. David Ryan once said, if you slid charts under his door, and gave him end of the day pricing, he'd make money. I believe him because I know I could do that too. But I have found that with this information, I'm even more likely to make money, more money, and to find situations that are great opportunities. So I use everything. I want to get stocks that have the earnings too, but if I didn't even see the earnings and I traded off the charts, I would make money. So you can be a straight technician if you want.
I
But
can attest to that because that's how I started. The first few years, I didn't even look at the fundamentals, and I couldn't even afford a market surge. So I didn't even have them readily in front of me. I just traded the technicals, which we haven't even gotten into. So I can attest that is 100% true.
yeah, and we have really not talked about the technicals much. As much as we talked about the trend, we really have not talked about the real technical application of volatility contraction and how we find entry points and all that, which we're going to get into. That's the real fun stuff. We're still really on context, and in this area here, it's getting somewhat tactical, but it's still more qualifier because the reason why is tactical is you're really going to make a decision based on something. With this, we're really not making a decision based on the earnings. This is more of something that we would love to have, but we don't necessarily require. But even if we do require it, it has to be backed up by price. So ultimately, the final decision is made by price. If we want to really put the probabilities and stack them in our favor, then yes, we want as many elements as possible. But keep in mind, um, again, biotechs don't have earnings, right? So you got to know the category. You got to know how to apply this stuff. Turnaround situations you're going to require very big earnings. Stocks that are expanding their profit margins and it's a profit margin growth situation are not going to last as long. Revenue is going to have to come in, but they're tradable. They're tradable. An investable situation that I want to be in for the long term, I want to be in the early stages of some really exciting new technology or product or service and company that's able to scale their company and grow their earnings and accelerate them for an extended period of time. So this would be valuable for that. If you're short-term trading, you can pretty much throw all the fundamentals out the door and just trade price. Um, what I'm trying to show you is the nature of the markets and how it works. Why are these stocks doing what they do? What are the institutions, the analysts, what are they thinking, and how are you going to, among all these people, these smart people, and all these people all fighting for that same dollar that you're fighting for, how are you going to beat them? How are you going to outperform them? Well, first of all, just so you know, as we go through all this, a lot of people say, well, if you wrote books, O'Neill wrote books. If it's so easy, then why isn't everybody rich? Why doesn't everybody do it? Well, I'll tell you this. Why isn't everybody thin and in shape? Why do people that want to not smoke still smoke and drink alcohol? It's called discipline. And that's what we have a big lack of. If there's anything that really, really contributes to the inefficient pricing, it's discipline, lack of. And once again, it's timeless. It's timeless. It's emotion. It's timeless. If you think all of a sudden everybody's going to become disciplined and everybody's going to act like winners and professionals and do the right thing, you are mistaken. Because there's only a small handful that can stay the course, that will be willing to stay the course and go through the tough times and believe in themselves. It really comes down to belief in yourself, belief in what you're doing, because eventually you run into a tough time and you've got to now believe in the process. This is the same thing of going back. I'm going to take it back to racing again because it's so apropos. It's such a good analogy. When I do everything, I race on brand new tires. I change my tires, my brakes, everything more than I have to. I change my oil, my brake fluid. I've got the best safety equipment. When I'm at VIR in Virginia and I go down the back straight and I'm at doing 168 and I got to come down to 43 miles an hour in 100 feet, I have to trust those brakes. I got to trust that car. I got to trust that everything up to that point has been, I did everything that I could to make that car perform. And if there happens to be a malfunction, it can happen. It can happen, but I've done everything that I can do and I fully trust it. It's the only choice I have. I have to trust it at that point. My life is in the hands. So that's not easy for people, to do in this kind of situation. Um, Especially nowadays, there's so much information out there. You go on YouTube, this guy's making a ton of money. He did it this way. I mean, just flip flopping all over the place. I would say discipline is harder now than ever before. If anything is really changed, it's that we are seduced on a minute by minute basis. And the real crazy thing is that we're seduced and we allow it. It's incredible. I can't believe somebody would go and follow somebody on Twitter or Facebook or whatever on YouTube and that never made up $10 million from themselves, and they're telling you how to make $10 million. I don't really understand that. I wouldn't listen to somebody if they didn't already do it for themselves. But there's all these self-proclaimed experts, and we've got AI and all these seductive ads. We're being bombarded, and we're being led to we're being led away from our values very, very easily with dopamine hits. So this is where there's a greater opportunity than ever for those of you that are disciplined and stay the course and learn everything there is to learn about a strategy. That's why I'm going to keep coming back to this, because I could show you, I could write this stuff and publish it in the Wall Street Journal. I did. I wrote books, right? I got 4 books, 3 stock market books. I got another stock market book I'm releasing next year, which I promise you it is coming out next year. I know I said that last year. This year, I'm really making it a priority to finish it up.
Golden tangent
I
right there.
told the world, not everybody doesn't go win a U.S. investing championship. Everybody doesn't make 100% returns and make millions of dollars. Most people don't, because they're not disciplined. They don't have belief in themselves. They don't have belief in the strategy.
I'll
Oh,
share just a really quick story from the first Master Trader program, because I was thinking the same thing, why hasn't everybody, made a fortune this way or whatever? And I realized the discipline to follow through on all the things you're going to learn over the next couple of days is actually the real hard part. But I bumped into someone at the airport as we were leaving the last gala, and the guy said, "Hey, do you remember me?" Uh, and it was somebody from the first Master Trader program. And I said, "Oh,
wow.
how you been doing?" And he said, "Well, I didn't really." I just kind of didn't stick to any of the stuff. And then I saw how you and Brandon did whatever, in the 14 years since. And I figured I gotta, get back in gear and because I realized I had this missed opportunity. And I just remember saying to him, I was like, well, it's never a better opportunity to convince yourself than now.
Yeah, wow. It's back 14 years later. Um, well, look, it's hard enough. Most people can't even make it through this program, through the Master Trader program, and keep the attention and really apply themselves. That this is hard. This is a lot of work, and this is just the very, very beginning of your journey. So, and on top of it, we've had thousands and thousands of people come to the Master Trader program and be our members. But you know what? There's millions and tens of millions and hundreds of millions of people out there. And so they're not even interested. Most people aren't even interested in doing it the right way and getting the right information. And this is no different than anything else, any industry. There's only a small handful, 1%ers of lawyers, baseball players, basketball players, you name it. In any industry, there's only going to be a small handful, because there's only a small handful of people that are disciplined. By the way, I have a cap right here. I'll show you. This is by invite only. I only give these caps to people who I think earn it, friends and family and people that I know. This is, you see this right here. It says this is the Minervini 0.1% club. That has nothing to do with net worth. Although you will get to the 0.1% net worth if you are a fraction and you are a 1/10 of a percenter. This is for those who are in the 1/10 of a percent of the population in passion, commitment, willingness, and discipline. All right. And you're a fraction. You're a fraction of the world, because most people, they're not passionate and committed and disciplined and willing and have the expectancy of a winner. And when you can be a 1/10 of a percenter in those things, then you could be a 1/10 of a percenter in anything else, and you could be the best basketball player. But that comes first. That comes first. Or it's certainly, that's what you're going to need. So that's why you got to believe in yourself, and you got to believe in what your mission and what you're doing. Let me go back. I know I'm going off here on a tangent, but it's an important tangent. Let's go back here. I want to show you something that's, I think, very eye-opening. This has been I did this one year, and I really got great feedback from it. It's kind of an aha moment. But in the 2013, I was asked to pick a stock. Like, if I was to pick a stock, pick a stock that you would pick that meets the criteria. And I said, okay. I said, I'll pick a stock, and then next year we'll look back at it and see what happened, just for fun. So I picked Home Depot at the time. Um, and this is what it looked like. We had the Master Trader program, I think, and it was September, October, it was right around here. This is what it looked like. It had a 4% growth rate, 21 PE. the last earnings were pretty nice. There was a little bit of deceleration, but they're averaging about 29% versus a growth rate. There was some acceleration there. Previous quarters, you can see it was an acceleration there. It was in a confirmed stage 2 uptrend, had a 17-week base, uh, strong RS. RS was 90. So it met all the criteria, near new highs. I picked that stock, right? Okay, the following year, 1 year later, I said, let's go back and look at this. At the next Master Trader program, I said, hey, last year I picked this stock and we were doing an experiment. Let's take a look at this. Now, this experiment has nothing to do with whether it's a winner or a loser to say, hey, we picked a stock that went up. What we want to look at is when I picked this stock right here, the relative strength was 90, right? The growth rate was 4%. The PE was 21. The earnings, right? The earnings for the estimates. I'm going to go back to this slide again. These are estimates right here. The estimates were 297 and 337. Okay. What actually happened was 307, a little bit better than the 297, but then look at 2014, 376 versus 337, much better. You see, as you go out, the visibility, the ability to predict goes down, and the stock, the company had a much better earnings report than was estimated. Now, the growth rate went up, went from 4 to 23. The stock made a nice big move, and during that time, the PE didn't change at all. The stock is, I don't know, what was it at? 50-ish, 50, 55, and went up almost a double. The stock almost doubled, and the PE had not changed. It was as equally as good of a value up here as it was down here because the earnings grew. You can see these are the earnings going forward. The earnings grew, the growth rate accelerated and improved the growth rate, and the estimates were conservative. And that's where the opportunity was. And look at the relative strength. The relative strength actually went down. It's underperformed during this period. So again, people say, well, I'm going to buy the relative strength when it's a 50 and before it becomes a 90. No, it's relative strength. You want to buy a 99. You want to buy the best performing, the highest relative strength at the time. This is where you want it to be when you're buying the stock. So then 2014, when I showed that stock, I said, let's do just the opposite this year. And I had not had the clairvoyance or to know what's going to happen. This was happening in real time. I said, let's pick a stock that I would avoid and maybe even short. I want to pick a stock that I say, you know what, this is an avoid. It meets all the opposite criteria. Okay, so one that's in stage 4, not stage 2, has decelerating earnings, negative earnings. All right, the PE is 22. You're at stage 4. The relative strength is a 3. That's essentially backwards at 97, right? That's almost your worst 3% in relative strength. So now we're really just flipping the whole equation. Again, this is not to say, hey, I picked the stock that went down, because it did. Well, it actually went up first a little bit and then it went down. But here's the important thing. Take a look at the estimates. The estimates were 267 for 2014 and 322, right? We go back, here they are. 267, 322. Those were the estimates. Look what actually happened. 231, and then in 2015, instead of 322, they lost $1.20. How's that for a miss? You see why? And look at the price. The price gets annihilated, and the PE now, okay, the PE is now it's 86. It's higher valued, down 80-90%. Now it's way higher valued. How does that happen? Because it's losing money now. You see the limited visibility? They were looking for growth because the estimates are revised slowly and conservatively with limited visibility. And there's the inefficient pricing. This is the inefficiency in pricing.
Well, and just
So
to highlight too, Mark, you pointed out once the stock goes into stage 4, you had the biggest break, and entire change of character. And you look back and you go, well, that was a great place to get out of the stock. Because the real bad news hasn't shown up yet. And we see this time and time and time again.
yeah, we got a big break right here. Big volume right here, right? That was before it really unraveled. And that's why right here, this is where you're looking at this as a potential short. Now you've got the 200-day in a downtrend. It comes back right to the 200-day here, but you're in a downtrend. You're in stage 4. I mean, this is the equivalent of an early turn on the downside. Right here is your early turn down. This is where you should be long gone out of this stock. If this would be the last, if I was holding this maybe for a big giant move, this would be the last place I would be getting out of everything. If I didn't sell prior to that, or maybe I scaled out, that's it. You're under the 200 days rolling over, out, out. Now the big break happens, the institutions are, and then look, more volume, more volume. Again, this is not Aunt Betty. It's not Aunt Betty selling, right? So the institutions are getting out now, and you see how they have to play catch up. They have to play catch up because the revisions are done slowly, conservatively, with limited visibility. Let me erase all this stuff out of here. Okay. All right. So how do you know an earnings report's a good earnings report? Well, we talked about results being better than expected, coming in even better than expected, because a surprise is actually a surprise based on the average. I like to see the earnings come above the highest estimate, because the highest estimate is the rogue. That's the rogue estimate, that there might be a rogue analyst that is willing to go out on a limb a bit. And if you beat that too, if you beat the highest estimate, to me, that's a really strong beat. You get the company raises guidance, right? They raise guidance for the upcoming quarter and for the current year or the fiscal year, and you get a positive reaction. The main thing is the reaction. If the stock's down 15% and it meets all this criteria, but the stock's down 15%, well, then obviously it's a bad report. No matter what it looks like, the perception is it's a bad report, and that's all that matters. So I'm not going to go over all this, but this is what you look for when you have an earnings report. This happened with, there's a really good example is with Netflix. The stock was up on earnings really, really sharply. And you see it had a very small pullback and right back into new high ground. And it just would not go down. It gave you that initial response. You had subsequent strength and you were very resilient. That's what you want to rely upon. You want to rely upon the chart. This goes back to differential disclosure, right? This is not differential disclosure. This chart is confirming. It comes up on the big earnings. It's holding up, and it is saying, yes, this earnings report was good. It is indeed good. We're blessing it. And you don't want to go and fight against that. People go, oh, well, the earnings were great. The stock's down. It's a great company. I'm going to buy it. It's going to come back. That's just guessing. That's forecasting, right? That's not being disciplined and trading the chart. Let's see. All right. So we're not breaking yet, right?
No.
Okay, good. All right. So we're going to get to profit margins. Now, we've talked about earnings and sales, and now we're going to talk about profit margins. When it comes to growth stocks, those are the only three things I look at. Those are the only three things that are really important. People talk about book value, return on equity, all these things. I'm looking at sales, earnings, profit margins. That's it. That tells me everything I need to know, tells me the whole story. I slice them in a bunch of different ways. Remember, I looked at earnings, we looked at quarterly, sequential, year over year, and then sequential acceleration. We looked at a breakout year. We looked at earnings relative to its growth rate for turnaround situations. We looked at earnings acceleration. I'm sorry, sales acceleration along with earnings acceleration. Now we're getting into profit margins. Profit margins are really interesting because on their own, as I said before, profit margins on their own can increase profitability, right? We had a company, the Encore Wire, that had the stockpile of copper. right? So now they can pass on a price increase without an increase in their cost. That widens the profit margin. They're making more per whatever, pound, ton, right? They're making more money. But that can only go so far, right? That has nothing to do with the actual sales increase. You could have sales flat, but now you make more per sale and you make more money. But that's only going to go so far. Eventually, they're going to have to buy more at current prices, and they're not able to pass on that. That will pass on the price increase, but their raw material will be more, right? So you have to, or let's just say you're doing it another way. You're cutting cost. You're laying off people. You can only lay off so many people. So profit margins on their own can be helpful and they can be bullish and you can have a stock move on it, but it'll be limited. When the power comes when you couple them with revenue. When revenue's growing, I want to show you an example. Again, this is just making a really probably unrealistic. Well, it's realistic in the case of the growth, but probably not the size and the market capitalization. But I made this little grocery store. Okay, we call it a grocery store. It could be anything. Like I said before, it could be a plumbing business. But let's just say, because grocery stores have small margins, so I'm using a 1% real tiny margin here. You've got a grocery store that maybe isn't even doing that well, and their margins are squeezed. Normally they get 3% margins, they're only having 1% margins. This grocery store, we issued 100,000 shares for it, gave it a market cap of a million of a revenue of $1 million. Um, so now we got two scenarios. Okay, one scenario is that the revenue for this grocery store is going to grow at 25%, and we're going to keep the 1% profit margin consistent, right? They're still going to earn the same profit margin that they've been earning, or they did, let's say, last year. But we grow revenue by 25%. Well, obviously, that's going to grow the earnings by 25%, right? That's 25% more. You're going to take your $1 million times your 1%, $12,500 divided by your 100,000 shares, 12 point. It's going to be 12.5 cents per share. You're going to grow your earnings. You're going to grow at 25%. Okay, now let's take revenue growth at 25% and let's bump the margins by 1%. Now, 1% to 2% is a 100% bump in the margins, but we're bumping those margins on an increase in revenue by 25%. Now do the math. Now you've got it still does the company still does the same 1.25 million. They increased their revenue by $250,000, but now times 2%, that's a 25,000% profit. Divided into the 100,000 shares capitalization is 25% per share. Now earnings are up 150%. Do the math. We go from 25% to 150 with a 1% increase in in profit margins. That's the power. That's the compounding and the accelerant power of profit margins and revenue growth. I'll show you a real life example. So Ollie's, a company that David Ryan and I liked for a long time. I still love the company. I just don't love the stock right now. I was hoping it would set up, but a really great run company. Um, if you go back, you take a look at their earnings back in 2016, they had revenue that was up 16.8%. Their margins went from 4.7, right here, you see 4.7% to 6.7. That's a 2% increase in margins, right? Doesn't sound like much. Well, it's a 42% increase from 4.7 to 6.7 on a revenue increase of 16.8%. 16.8%. That boosted earnings 50%. That's a big earnings report. That's a big earnings number. 50% is a really healthy growth rate, right? Well, let's say that we took that profit margin expansion away, just that 2% profit margin expansion away. The earnings would only be 7.8%. So you see this accelerant that you're pouring on the revenue, and you get this much bigger earnings growth. So this is where when you understand this math and you look and you see the acceleration, this is why we look for acceleration and we look for expansion, profit margin expansion, uh, revenue and earnings acceleration, because you get an exponential or a or an accelerated rate of advance. And again, this just creates the conditions where it can't be discounted very well because it's happening too fast, right? That's why we want to stick with fast growth. And when you look at these stocks, you look at Apollo went up 850% when the Nasdaq went down 60. The Nasdaq was in one of the worst bear markets in the history of the country. One of the worst bear markets ever since the Great Depression, and Apollo went up 850%. Look at the profit margins, 11.7 to 14 to 16 to 18.4. Huge profit margin expansion. Panera Bread, same period where we went from 2000, Nasdaq went from 5,000 down to just a little over 1,000. Panera Bread went up 1,100% when the Nasdaq was down 80% in that period. Look at the profit margins, from 4.7 to 6.5, from 6.5 to 7.8, from 7.8 to 8.6. Over that 3 years, the profit margins expanded dramatically. They almost doubled from 4.7 to 8.6. You put that with revenue, you drive earnings, you get a stock price. Monster Beverage. Monster Beverage had big acceleration in sales, went from 20 to 63 to 93. But look at the profit margins, from 3.3% to 18%. It was a five-fold increase in margin. 3.3 to 5.4, 5.4 to 11.3, 11.3 to 18 on these huge sales. No wonder earnings were up 75, 214, 195, and the stock made this big move. The great turnaround, Apple. Apple's margins were down to zilch, nil. I think in the year before it literally said nil when I looked them up. 1.2%, insignificant, virtually no profit margins. Look at this story. This is one. That's why it's called the Great Turnaround. 1.2, 3.3, 9, 10, 14, from 1.2 to 23.9, a 20x move in margins and improvement. That's great management. That's great. That's a great product. That's selling great. That's efficiency, learning how to, however, I don't know what they did. They made it cheaper, and whatever they did, they're making more money per unit, raising prices. They had pricing power. They had everything. Every condition that you need, they had. And that's why Apple's Apple. It's all right there. Okay. NVIDIA is one of the modern day examples of this. Look at the profit margins, under 20% during this big move. Profit margins doubled, went to 50%, and the revenue exploded, right? So this is what we call the code 3 matrix, where what we do is, and the reason why we look at this is because institutions will key their screening on their computers to the last few quarters and the last few years, looking for the breakout year, looking for the acceleration. And basically, a code 1 would be you had 1 quarter of EPS. If you had 1 quarter of EPS acceleration and 1 quarter of revenue, you have one quarter of EPS revenue and net profit margins. You work your way up to the best situation, which would be a code 33. You have all three of them. So a code 33 just means 3 quarters of all three. Right? A code 32 would be 3 quarters of two, and so forth. The best situation is to have strong growth, several quarters of very strong growth, have profit margin expansion with revenue accelerating, and then that will give you very big earnings acceleration. Now, you're not going to have this perfect on every stock. Sometimes you'll have a great code 3 stock or code 33 stock, and sometimes it'll be a little bit more scattered and ambiguous, and sometimes you won't have it at all. But this is the optimal situation, and this is what you're looking for. You're looking for earnings, sales, and margins. People get into all this stuff and trying to figure out book value and break up all these calculations. Growth stocks move for one reason and one reason only: growth. That's what they're looking for, growth. If you have growth, that's what makes a growth stock. Growth comes from sales and margins. And you can even have a consistent margins. If sales are growing, you get growth. All right. And you can even have margins improve, but you get limited growth. But when you have sales and margins, you get explosive, enormous growth. So that's why that's what you want to look for. Now let's put this and let's take a look at a chart in NVIDIA and kind of put this together. So they've got this incredible growth. They've got this great story. They've got this somewhat of a monopoly on an industry. We get the early turn. The 200-day starts turning up. In this case, the 40-week. We're on a weekly chart. 200-day is the 40-week. 10-week is the 50-day. Now we form a base and we're in the stage 2. And this is where we want to start buying out of these bases, preferably the first base in a new stage 2 uptrend. But let's look and go back to the PE ratio. Let's look at the valuation. This stock gets into that new uptrend, right? And look at the valuation, 250 times earnings. Now the stock goes from 50 to almost 150, right? It triples. The valuation goes from 250 down to 60 times earnings, 70 times earnings. How does that happen? Because the earnings are growing faster than the stock price. This stock price still did not fully discount the earnings. Okay. All right. Here's what you want to watch for. Positive and negative. These are the things you're going to look for. I'm not going to go through them all. You have them here to look at, but you can look for code 3 stocks, look for acceleration, sales increasing, look for a breakout year, want strong annual earnings, as much acceleration as you can find. If you got really big deceleration, it's a warning flag. It's a warning flag on a stock that's been going up for a long time, for instance, like an NVIDIA. You start getting earnings deceleration, the stock keeps going higher. If that earnings deceleration persists and you start rolling over into stage 3, you want to get out. You want to get out because most likely the bad news hasn't come out yet. Eroding margins is a big warning. That's what happened in the beginning with Apple. The funny thing is that they were a margin story on the downside and they're a margin story on the upside. So if you margins eroding usually mean competition. Uh, um, if you're dealing with an area that maybe had pricing power and now their margins are eroding, they can't raise prices anymore. So now they've got to maybe lower their prices. Competition came in, they've got to compete, and competition is good for the buyer but not for the seller. So look for eroding margins. Positive earnings with negative sales, limited lifespan. Okay, because that means it's a margin story. If they don't have sales growing and earnings are growing, well, the only way that can happen is it's a margin story. They're increasing margins. That might be good for 1 or 2 quarters, but after that, you're going to have to see actual growth. Companies showing strong earnings, but they're not paying much in taxes. Big red flag. Big red flag. Why are that? I mean, you just think about it. If you made a bunch of money, why aren't you showing on your taxes? Which, if there's no way you can net money and not show it on your taxes. So now you start getting into accounting gimmickry and things like that. You get into forensic, accounting, differential disclosure. I'm not looking too deeply into these things. Okay, to be honest with you, I started off doing very deep forensic accounting work, CFA type work, quant work. I did nothing but lose money and only market perform when I was doing well. Then I changed to chart, stock, group, market, fundamentals only if confirmed by the price and the price trumping everything. And that's where I made all my money, all my wealth, and the rest is history. So now I don't know, where are we, Bob, as far as where are we on this mountain here? As far as
All right. So
how
we're
much
going to take
more
a
we
break here.
have today, where we
Yeah.
breaks. Yeah.
We're going to take a break today. I mean, right now for 15 minutes. We'll come back for the last session of day 1, which is the picture worth $1 million. At the conclusion of that, we will have time for Q&A, questions can be written. Remember, you have to have the page number to the question you're asking. If there's no page number, there's no way we're going to find it out of all the pages we've reviewed.
Right.
But send via email, not on the chat box because it will be lost, but in an email to workshop@minervini.com. That will be where you can send your questions and we'll be able to go through a bunch of them at the end of next session. So let's take 15 minutes here, Mark.
Yeah,
It's
we're gonna come
1:40.
down to an aerial view and we're gonna start getting into actual price and getting a little more specific. Not yet completely tactical, but definitely we're gonna zoom in a bit on the next one and get into some of the I'd say the more fun stuff. But certainly we're still on perspective. I just want you to know we're still on context and perspective. We have not drilled down to real tools and tactics yet. But go ahead. I'm sorry, Bob. What were
Yeah,
you
so
saying?
1:40 local time, 15 minutes, 1:55, we'll pick it back up. And with that said, we'll see you in 15 minutes and we'll finish the last session of day one.
Okay, I'm seeing a little bit. Bye bye.